for us as a fund manager, it'll be about finding the right opportunities. There's a lot of demand for assets, so we'll have to work really hard to identify opportunities for our investor clients. One thing we do very well is buy off market, so we use our relationships with our agents and with owners to buy these assets before they actually come onto the market. In terms of sectors, I think the tough sector is going to be retail. E-commerce is really affected a lot of the shopping centres, and you're seeing those yields start to blow out. We only own one retail centre in our portfolio of 80 odd assets, but I can see that as a continuing theme in that retail sector. With the industrial sector, it's all around e-commerce. So with the significant growth in online retailing, we're seeing huge tenant demand for well-located warehouses closer to the CBDs. And the reason for this is so that they can service the consumers with their online purchases. So what we're seeing is forecast rental growth as this demand plays out, and because of that, we're seeing a lot of groups try to buy industrial assets. So we're seeing the Australian REITs, the Australian wholesale funds, the Singaporean REITs, private equity groups such as Blackstone, as well as high net worths, all looking to get into the industrial sector. With the commercial sector, Sydney and Melbourne are definitely the standouts. So Sydney has been driven by infrastructure spend and lack of supply. So the current Sydney vacancy rate's 4.1% as at January of this year, which is one of the lowest rates it's ever been. So this is driven by not a lot of assets coming out of the ground, and also infrastructure spend such as the metro rail. On the Melbourne side of things, it's all around population growth. And again, they don't have a lot of supply coming on at the moment, but over the next couple of years that will steadily increase. If you look at Brisbane and Perth, they have still been affected by the mining downturn. So their vacancy rates are decreasing. So if you look at Brisbane, we're down to about 13%, so that's dropped about 1.5% over the last 6 months, and Perth's at 18.5%, which has dropped about 1%. So they're still quite stubbornly high, and incentives in those markets are still high, but they are dropping. We're seeing the supply start to be absorbed, both Brisbane and Perth, as tenant demand increases from some of the non-mining related industries. Yeah, look, in my opinion, I think they'll both continue to be strong. Commercial property, both in Sydney and Melbourne, will go from strength to strength. The supply is still a little way off. Industrial, I can't see that demand quietening down at all. The demand is increasing. The whole e-commerce story is getting stronger and stronger, and we're starting to see that rental growth come through, particularly in Sydney. So I can see the demand for those assets continuing to grow. Well, look, we've seen the group economists from most major banks now forecasting 1 to 3 cuts over the next 12 months, which is quite a change from 6 to 12 months ago. Usually how this plays out means increased demand for yield plays such as commercial property. So I think both industrial and commercial will stay strong over the next 12 to 18 months. People will be looking for yield, and commercial industrial property is one place where they can get it. Yeah, look, our funds have been performing really well. We've had 6 out of the top 10 funds in the PCA IPD Australian unlisted core retail property fund index for the last 7 quarters. On the occupancy side of things, we've had our vacancy rates are as low as they've ever been. And with our unlisted open-ended fund, CDPF, we're about to buy the first direct asset in that fund, which is quite exciting as well.